Today was one of the most important for the financial system all year long. I'm going to break down everything that you need to know. The first thing I want to look at is what happened. You're going to learn all of that. The second thing is why it happened. And the third is what will happen. All of this information will be disclosed in this video here. I will unveil that for you. As always, let's begin. I'm sure you are already aware, but I need to cover it here and just outline exactly what happened. Fed will aggressively dial back its bond buying, sees 3 rate hikes next year. Now, I know what you're saying out there. No way, the Federal Reserve is not going to do this. The market is going to react according to what they believe. And of course, we can see not just in that particular trading session, but over the last little while, there have been some changes. If you want to know what the Federal Reserve is doing, at least the information that is public, simply go to a search engine and type in Fed H41 and you could see their schedule and you could see the balance sheet changes. You could look at their loans. You could look at all of that in one snapshot, updated weekly. It's Fed H41. So here we go looking at the CNBC version, or we can simply look at the actual data. I always, if you're new to this channel, I always pull up the information directly from the source. Here you can see December 15, 2021, Federal Reserve issues the FOMC statement. And guess what? It's everything that you heard. Simply the fact that the economy is getting better and that the Federal Reserve is willing to go away from the policies that they had in place previously. So they're going to be reducing the amount of money that they print every month. They're still expanding their balance sheet. They are still keeping interest rates at 0% for the time being. The understanding here is that in 2022, they will be increasing interest rates 3 times. So we can expect, according to what they're saying, we can expect interest rates to be at 0.75%. Based on my back of the napkin type of calculation, we get to a very, very tight policy once we are at 0.75 to 1.0. That's it, historically, going back. It was at 5.5 in 2 cycles ago, then it was 2.5 at the maximum, and now I predict that somewhere around that 0.75 to 1.0 is the equivalent of those previous tops. That doesn't give them much room. That does not allow them much policy space, but that's where we are at. This is out of the AP. Why the Fed feels now is the time to tighten credit more quickly. So like I said a moment ago, I want to start breaking down the who, what, when, where, and why. But this is what I need to get into first, okay? Just really quickly. Right. You could see Federal Reserve Chair Jerome Powell responding to surging inflation by counseling patients and stressing that the Fed wanted to see unemployment return to near levels before 2020, before it would raise interest rates. And now they have suggested and made it clear in their actual FOMC statements, and of course the press conference after, that the Federal Reserve sees inflation running too high for too long. And it's interesting, to say the least, that while their actions supposedly have no impact on inflation, that they're changing their actions in response to inflation. Isn't that funny? Isn't that unusual? Wow. Okay, so we've got inflation based on their metrics at a 4-decade high. And as a result of this, they suggest that they are going to start pulling back on their bond purchases and saying that, hey, we have to change what we're doing. We are looking at the economy and, as they say here, with elevated levels of inflation, you're looking at the pressures rising rapidly in the strengthening labor market. The economy no longer needs the increasing amounts of policy support. So the general trend here is to pull back. And it's not just the Federal Reserve. Other central banks around the world are doing the same thing. Now, let's look at this here. This is a mess. I realize that, okay? But what we need to know is that from this, as well as this, and I think it'd be better off if you go into the links into the description and look at these sources if you are interested. But for a moment here, let's take a look at what I have written down separately on the screen here down below. And I'm going to be showing you and talking about what has happened, why it has happened. Okay. Right now, just over the last little while, we have seen multiple negative days. Okay. You've noted that actually over the past month, but really over this last week, as we've been going and inching closer into this Fed meeting, the market has reacted negatively. That has been very clear. Another thing is that the markets anticipated everything that we saw in this particular meeting. It was very clear. That was all over the news. One, Goldman Sachs guy, JP Morgan guy, they were all talking about this. All right. Most of the Fed days generally tend to be positive. It might get a bit iffy, but at around 2:30 or so and beyond, maybe around 3 o'clock or so, things usually turn up higher. Then we have, on top of all that, the year-end or Santa Claus rally. This is a time frame in which markets generally, seasonally react very well. By the end of the year, a lot of hedge funds, a lot of pension funds, a lot of all these different institutions need to start buying. Okay, usually they're buying at the end of the year, depending. It's end of quarter, end of year, but that right now looks to be very attractive during this period of time. And last but not least, CTAs, or the computer algorithms, you could see this structurally, they were positioned to go long during this time. So they're positioned in that way. That's the way this has been going now. I mean, there's sort of that back and forth. Some hedge funds had been selling off, retail traders buying in, but the computer algorithms are essentially positioned towards the long side. Now, all of that to talk about simply why it happened. And I think that is very clear when you look at all of the data as it has added up. You compare this historically to what we have seen before, and we get a little bit of a parallel. I don't want to necessarily use that word, but this is what we see. There's this irrational exuberance in the markets heading higher despite what we had seen. Okay. Now, this happens to be the S&P 500 just over a couple time frames. Let me just show you that. It's probably better. If you look at the S&P, the Dow Jones, the NASDAQ, and actually that's set up incorrectly. That should be the small caps IWM. But anyway, we're looking at this right now. Markets head higher on the day, on that particular trading session, but we can see where it has been. Okay, largely they were oversold over the last month and have perhaps picked up from their bottom. We will see if they do hit records. But the point here is that you have some that are not reacting very well, and that is ARK being one of them. Just one of them. Look at this. The percentage of countries, ETFs, outperforming the S&P 500 on a rolling one-year basis has fallen to the lowest level since May of 2020. Look at this. You are seeing where the money has gone. Now, when there is underperformance, sometimes a lot of money will flow there when they feel like everything's been squeezed out of something else. So maybe that's the way the market is treating tech stocks right now, and instead putting their money elsewhere. Now this here, really big, okay? And I'll get into this, but hold on for a second, okay? Let's talk about this. What will happen? And then we'll lead into that as I just showed you, okay? Give you a little sneak peek. What will happen? If the markets fall, the expectation is that the Fed will come to the rescue. The Federal Reserve coming to the rescue, simply reversing course, maybe expanding their balance sheets, maybe if they do get to increase interest rates, that they'll roll that back. As I've said, 0.75 to 1.0 seems to be a very tight policy space for them. Another thing, policy mistake means a quick reversal. So that policy mistake, essentially not keeping interest rates at 0%, could be met with a quick reversal. Nobody knows until that time comes, of course. But I would suggest to you, for a second, if you wouldn't mind, to just get in this headspace, okay? What if the Federal Reserve is intentionally, purposely creating a plug pull or a rug pull environment intentionally? What if they're doing this on purpose to create a crisis and then have their friends, their shareholders, buy up everything on the cheap? They could simply leave interest rates at super low levels. Hey, we've been hearing this all the time. Oh, don't worry about all of that that's going on, because the Federal Reserve is in control. The Federal Reserve's actions do not create inflation. And so why not just leave interest rates at rock bottom? Why not just print as much? Why not print $1 trillion every single day when your actions do not create inflation and have apparently no negative effect? Why not just print $1 trillion? That is a question I have. Well, of course, it does have an impact. It does create problems. And the dislocations are being felt today. Looking at this. This article right here, out of the Wall Street Journal. It's written by Kevin Warsh. Warsh. The Fed, by the way, this is a former Fed governor. So we're talking about one of the highest ranking positions at the Federal Reserve. Former. This is a quote. He wrote this article. The Fed is the main inflation culprit. The central bank has enabled price increases that may soon pose a risk to financial stability. If you do agree with that line, hit that thumbs up. Let me know what you think. Put it in the comments below. Let's talk about this, okay? It is, as far as I'm aware, as far as I have seen historically, this is the case. The Federal Reserve is the main inflation culprit. They are behind all of this, and they are destroying the value of your currency every single day. They create the crisis intentionally. Let me know what you think of this. Hit that thumbs up to support me. Let me know. If you don't, hit that thumbs down. Make your voice be heard. I think it's really key to understand all of this. I try to show you what I can to make sense of it all, to break it down and easy. There's so many out there, millions of subscribers these people have, and all they give you is their opinions. And while that might be great for the radio talk shows and so on, we need to know what's actually happening, okay? Like they need to know. Aim higher, people. Let's aim higher. Let's make this happen for ourselves, for our families. Let's protect ourselves. How are we going to do that? We're going to hedge against inflation. We're going to learn skills. We're going to have these things in place already before it's too late. If you want to support the channel, simply hit that thumbs up button. It's right down there, and subscribe if you haven't already. And probably about 10% of you think you're subscribed but are actually not, because the algorithms like to screw that up. But whole different story. If you haven't seen this video yet, you definitely want to check it out. So just click it and I'll see you there.